Welcome to All Things Financial with Jack Driscoll. Each week, Jack takes on all things you thought were hard to understand about your finances and makes it fun, easy, but most of all interesting. From insurance to the best way to save your money and squeeze the most out of the dollars you put aside for your rainy day. And now, you have a friend in the money business. Here's your host, Jack Driscoll.
Welcome back again, everyone, to another edition of All Things Financial. What I wanted to talk to you about today is the issue of how to protect your family. And typically what I'm looking at when we first start this discussion is how to protect your family if anything happens to you if you're the breadwinner, or how to protect your family if maybe both you and your spouse would be in a financial situation that if anything happened to the other one, you'd be in financial straits. So we get into different stages of life. We get into when you're in your 20s, when you're in your 30s. It's different than when you're in your 50s and in your 60s. And again, it's different when you're in your 80s. So you still have to protect your family in your 80s, believe it or not. We run into, number one, a spouse who might be financially impacted if anything happens to the other spouse. And in the 80s, that might mean one spouse goes into the nursing home and drains all the assets on the other spouse. Or one spouse dies and leaves the other spouse with no pension and no Social Security as a double, you know, how each of you get Social Security checks. If one of you die, one of the checks die. We get back to the 20s and we say, okay, we're just single or newly married, and now we just bought a house. We're financially impacted in many cases if one spouse goes down, and that's either due to disability or premature death, the financial impacts to the other spouse. What we find in many cases are homes being lost, the surviving families having to adjust, where if we really thought about that in advance and did some financial planning in advance, I get a lot of young families saying, I don't know if I have enough money that I need a financial planner or could afford one. And we sit and we say, you know, we deal in different stages with people's lives too. Financial planners, a certified financial planner, is typically trying to serve people with their knowledge and their skills. So when I look at a family, I'm looking at a young family's needs and trying to help a young family solve some of the problems they don't yet have, but if anything happened to them that was beyond their control that they might have, if it's preventable. We can't prevent the issue or occurrence in many cases, but we can sometimes prevent the financial impact those occurrences have. So what I want to do today is I want to start with a discussion of life insurance at different stages of a person's life. We start with programming needs, then we go into the different types of products to solve those needs. We're transferring the risk to insurance companies. So we accept the risk. We could die prematurely. And I'll share this with you. Almost everyone dies at the wrong time. We either die too soon or we live too long. And I'll explain that, but when we get into this type of planning, I want to program needs because we want to make sure to not cause undue financial impact or even devastation. So we call that programming needs, and then we go out to the types of products, whether we use term insurance or whole life insurance or universal insurance or group term insurance. I'll share some of those with you. So number one is programming your needs, whether they're short-term needs or long-term needs or permanent needs. And then third, we get into reviewing what you have and seeing if it's any good. So let me start with programming needs. If you're in your younger years, I have to share with you, no matter what age you are, whether you're in your 60s or your 20s or your 80s, there is a cost to wait. What I mean by that is most people look at any expense as, well, it's too expensive for me right now. And it doesn't matter what the expense is, whether it's long-term care insurance or life insurance. I hear people with long-term care insurance say, well, I don't want to pay all those premiums for long-term care insurance. And then if I never use it or never need it, all that money's wasted. And then those same people are buying term life insurance. And the difference is, when we shop for life insurance, if you buy whole life insurance or guaranteed permanent insurance, you know somebody's going to receive that benefit as long as you continue paying the premiums and that policy stays in force. Because it's not a policy for if you die, it's a policy for when you die. Where term insurance is a policy for if you die. And I mean if you die within the scheduled term that you bought. So everybody tells me term insurance is cheaper. We do term insurance. When you go online and shop for term insurance, it costs the same as it does through an agent that shops for term insurance typically. Well, I mean, we're using the same tools online. The difference is you have a skilled professional helping you in step one, which is programming your needs. Most people jump on their own individually to step two, shopping for the insurance. So they're skipping over the most important part, which is programming your needs. So I'll share that with you right now. You're a young family or an old family or an older couple in retirement or a single in retirement. Let's talk about that. A younger family, you're programming your needs. What that means is sit and think. That's really all that means. What would happen to my family if anything happened to me? And if you're younger, you say if I'm disabled or if I die, whatever would cause anything to happen to you. So I'm going to share something with you. The loss of you is not the problem for the financial impact to your family, nor is it the loss of your spouse. It's the loss of the paycheck. So you have to understand that. What you're insuring is the paycheck, not the loss of you. The loss of you doesn't cause the financial impact. The loss of your paycheck does. So what we're trying to do is insure paychecks. When we program needs, we say, why do I need to substitute this risk or transfer this risk if anything happens to me? It's because I need a paycheck to come from somewhere else now to provide for my family, or they're going to get wiped out. And the way that works is you say, okay, I need a paycheck if I'm, and then you stop and think about it. And that's all programming needs is. So you say, well, if anything happened to me and my paycheck stopped or I was no longer able to work, I would want my home paid off. I would want my cars paid off. I would want my credit bills paid off. I would want my college funds for my children immediately completed or established, funded, fully funded. I would want my retirement planning for my surviving spouse fully funded because I now can no longer do it if you're not there or if you're disabled and your paycheck stopped. I would want enough money coming in to replace my paycheck, you would say. Do you see how that works? So if you make $2,000 a month or $4,000 a month, you'd say if anything happens to me, they still need the $2,000 a month or $4,000 a month to come in. I need to make sure where that's going to come from. Whether I'm disabled and that's where we lost our paycheck, or whether I prematurely died, I was in a car accident. Do you see how that works? That is what we call programming needs. That is the step almost everyone skips. You go straight to the internet, you shop for insurance. What do? Pick a number out of the air, ask the rep, how much insurance should we really have? How much life insurance? Oh, almost 100,000 or 500,000 or $1 million or 4 times your salary. Forget about all of that. Sit on a blank sheet of paper on a Saturday afternoon and just sit and think for 5 minutes. It won't take you long. And here's what you're trying to find. How much monthly income will my family continue to need, or my survivors, whoever they are? What are the bills that we now have that I'd want paid off? And what are the goals I'm trying to accomplish and save for that would be interrupted or ended, like college saving or retirement saving? So you have lump sum current goals, which is pay off your bills. You have lump sum future goals, which are target date retirement and target date college, let's say. And then you have an ongoing stream of income goals, which is to continue being able to pay the bills and live with your family financially living the same as they were when you were here. That's programming your needs, folks. That's what it is. It is that simple. It's just nobody does it. But if you do that, then you go to a competent financial professional and you're programming your needs, and here's what you go in with. You go in with that sheet of paper. You say, listen, I saw on TV I'm supposed to program my needs, but I don't know what to do with it after I do. So here's what I have. The financial planner on TV, which was me, said, I need a monthly goal, and that's to replace my income. So I need $4,000 a month to continue until I'm 65, or would have been 65, let's say. I need my retirement goal set up, and I need my college funding set up. They're my future goals. And then my current bills to be paid off. So you hand it to the financial planner, certified financial planner, not just a life insurance agent, because they'll sell you all the life insurance and not solve any of the other goals possibly. You want to get to, give us a call even, we'll help you do it. But you get to the point where you say, how do I do the monthly income? I know how to do the lump sum, but how do I do the monthly income? There are a number of different ways to do it, but here's a simple one. If you had any lump sum of money, how much would it need to be to pay $3,000 or $4,000 a month forever? Because you need the money coming in even after retirement. So you look at that and say, well, if I have a retirement fund, I don't need extra money monthly. And if I don't have a retirement fund, I do. So that's fine. We'll work that out. But here's an example. If you have interest rates and you say, I can't afford to take a risk. If my spouse died and I inherited $1 million, we are not comfortable, you might say, putting that into the stock market. So I might want to keep that safe because it's money I can't afford to lose, you might say. And finally, you'd say, how much can I earn on that money? I'd like to only spend interest and never touch principal. All right. If you can earn 3% interest safely today, and I say, how about 5%? And you say, I don't think we can earn that safely. We'd have to take risk. Then let's say we find your comfort level is 3% interest, should be able to keep that principal safe. Then all you do is divide. You say, for instance, I'll make the numbers easy. $3,000 a month. Let's pretend that's your need. That's $36,000 a year, which is 3.6% interest on $1 million before tax. That's a rough rule of thumb. So you'd say for every $3,000 a month I need, I might need $1 million. Now, that's programming your needs. Step 2, what product do we buy to get all of that money? Or do we instead choose we need to start saving toward that goal of having $1 million to replace my income? So it's an income replacement strategy, let's say. Now, don't forget, we still have the lump sum strategies and solutions we have to buy for too. So that $1 million in this example only covers the monthly income replacement. We might need another $300,000 to pay off a mortgage and all your credit card bills. Now we're at $1.3 million. But the credit card bills and the mortgage might only be 20 years left. So that might be a temporary need where the monthly income might be a permanent need. So let's get into product design. You might need $1 million whole life for permanent insurance, guaranteed permanent insurance, and you might need $300,000 in that case, term insurance for 20 years only. Because after that term of 20 years, if nothing happened to you and everything went well, you could jettison the term coverage, no longer pay any premiums for coverage you no longer need. You see how that works? So you could buy what we call term insurance for scheduled temporary needs that go away in time, and whole life insurance or permanent, guaranteed permanent insurance. And a lot of people use universal life insurance for your permanent needs. I'll get into the third stage of this, which is the evaluation of your current permanent insurance and if it's any good. And that'll deal with the discussion of universal life with whole life. And then you look at your future lump sum needs. And the future lump sum needs might be, but in 20 years, I wanted a $200,000 college savings fund to start for the next 4 to 8 years for my 2 or 3 children. So your term need might actually be 30 years instead of 20 in this example. So you might have a combination of term insurance and permanent insurance is my point. So when we get to products, here are the types of products generally. There's term life insurance, there's universal life insurance, and there's whole life insurance. There are others, but those are the 3 major categories. Term life insurance is bought for a period of years. There's annual renewable term, which is 1 year term at a time, and you rebuy it every year or renew it, and the rate goes up a little bit every year as you get older. That's annual renewable term. It renews every year, but it's guaranteed renewable usually forever, if you can afford it, which you won't be able to later. Now, the term life insurance we see advertised all over the place is typically level term insurance. That's buying a specific period of time with a level premium and a level death benefit. 5-year term, 10-year term, 30-year term. That's the longest most can go. And when you're over age 50 or 55, you will find 30-year term insurance is no longer commonly available. So you'll find yourself resorting to 20-year term being the only product available on the term side after either age 50 or 55 with most companies. So the term life discussion, people say term insurance is cheaper. I'm going to get back to my cost to wait. Remember in the beginning of the show, I said there is a cost to wait in both life insurance and long-term care insurance, in any kind of insurance that deals with time and health. The cost to wait in life insurance, you will find that term insurance, people will say, is less expensive. It's cheaper. When you look at term insurance, it is cheaper. So you'll look at a term insurance policy in your 20s or 30s, and it might be, you've seen the ads on TV or on the internet, it might be $20 a month or $40 a month for a 20-year term policy, and you'll $250,000 death benefit or whatever. So it sounds really cheap because it is. And you'll then get into the situation that most get into when you're in your 50s or 55 or 60s and find out you don't have enough money saved for retirement. You don't have enough money saved for college funding. Guess what, folks? We have a financial aid crisis in student loans. Guess why? You didn't have enough money saved for your kids' college, or the kids didn't have enough money set aside, or whatever the situation is. That's all it is, folks. We find the case where once we're in our 50s and our kids are in college, we didn't have enough money saved up. So we're taking out second mortgages when our clearly defined plans in our 20s and 30s were have our mortgages paid off in the 50s and 60s. We messed up. So now things got in the way. We're in our 50s. We don't have enough money for college. We're taking out home equity mortgages, second mortgages, or first mortgages on our home, and our kids are taking these student financial aid. And I'll do a show on this in the future. But what is financial aid for college planning? It's loans. We used to have financial aid. It meant grants, giving money, the state, because we financially qualified. That term has gotten so far out of kilter. Financial aid now means you go in and you're going to a loan broker, really, which is the financial aid department in your high school or your college, and you're getting loans, your parent loans and your student loans. And they don't need paid back until the kid gets out of college and they're in debt for life and they can't get out of it. I'll get into that in another show. But that's all actually a symptom of not adequately planning and preparing early enough. If you're starting to save for college when your child is 1 versus when your child is age 15, it's probably affordable when they're young enough. The cost to wait in every stage of planning is devastating. In term life insurance, you'll find yourselves, many of you in your 50s and 60s, realizing We still have mortgages to pay off. We still have student loans to pay back. We still have probably or possibility of home mortgages, car loans, and we don't have enough money for retirement. So now we're buying life insurance when you're in your 50s and your 60s, because if anything happens to either of you, if you're married, when you're in retirement, the other one needs a lump sum of money or income replacement to replace the Social Security check that's lost, possibly the pension that's lost, things like that. So we're finding that need. If that's the case, and we're buying potentially term insurance in our 50s or back in our 20s, we made a mistake in both of those cases. The cost to wait was we should have bought whole life insurance, which is guaranteed permanent insurance for our future needs way back in the 20s and 30s. And yes, they are predictable, folks. And yes, they are affordable, because whole life insurance can get to the point where it's actually free if you fund it or overfund it and make sure that in the later years, no further premiums might be due. So there are many strategies for whole life insurance, which brings me to my final point in this discussion for this show, stage 3. Evaluate your current policies. Are they any good, and will they fit the plan? Well, here's the situation we're running into. I want everyone listening and watching to pull out your current existing policies, whether they're term life or whether they're universal life or whether they're whole life. If you have whole life insurance and have taken loans against them, first off, I'll tell you shame on you. And secondly, I'll tell you you need to do a policy audit, a life insurance policy audit. If you have universal life, well, let me switch to term first. If you have term, you better find out when that's running out. And is that long enough, and will you still have financial needs, or is anyone financially dependent on you after that term runs out? Because if so, you're wasting your money if anything happens to you after that term, and all your money went to buy term insurance that expired by the time you needed it, which is at the time you die. That's the only time life insurance is any good. Let's talk about this universal life. We are finding, and I'm here to say, many, many, many universal life, and I mean very, very good and strong companies, universal life policies are failing, blowing up, running out of money, unknown to the premium payers, you the insureds. You must pull out your universal life policies, request an in-service policy illustration from the company, and do a diagnosis and what I would consider a medical evaluation or a policy audit to see if your life insurance policy is healthy or sick, running out and going to die before you do, when it was initially explained to you that it would last forever. These universal life policies are in trouble in many, many cases. Contact our office. We will do this for you at no charge, help you do a life insurance policy audit, especially on the universal life, but on any policy. Make sure your policies are as healthy as you are and outlast you instead of you outlasting them. We are seeing a crisis. This is an epidemic, folks. It needs addressed, and no one's talking about it. All right, we're out of time. Contact our office. We'll help you with that. We'll be back again next week with another edition of All Things Financial.
Securities and investment advisory services offered through SagePoint Financial Inc., member FINRA SIPC, and registered investment advisor. Insurance services offered through Driscoll Insurance and Financial Services Inc., which is not affiliated with SagePoint Financial Inc.